Let me tell you something that most investors are getting completely wrong right now. Everyone keeps talking about another 2008. They're waiting for the housing market to collapse. They're looking for credit default swaps blowing up. They're expecting banks to fail like dominoes. But that's not what's coming. What's coming looks a lot more like 1999. And if you don't understand the difference, you're going to get crushed in a very different way than you expect. I'm going to explain exactly why this market reminds me of the dot-com bubble, not the financial crisis. I'm going to show you the specific parallels that terrify me, and I'm going to tell you what's different this time that actually makes it worse. Because here's the thing that nobody wants to hear. The dot-com crash wiped out $5 trillion in market value. It took the NASDAQ 15 years to recover, and we're setting up for something that could be even more painful. Let me start with a story that changed how I see market cycles forever. In 1998, I was a medical resident at Stanford. I'd gone to medical school, I'd done my neurology training, and I was supposed to become a doctor, but I spent every spare moment I had studying markets and reading financial statements. My colleagues thought I was crazy. They'd find me in the call room at 2 in the morning reading annual reports instead of sleeping. And that year, I watched something that fascinated and horrified me in equal measure. I watched the dot-com bubble inflate in real time. Companies with no revenue were going public at billion-dollar valuations. Pets.com was spending millions on Super Bowl ads while losing money on every transaction. Webvan was going to revolutionize grocery delivery with negative unit economics. And investors were throwing money at anything with .com in the name. I remember reading these prospectuses and thinking, this is insane. These aren't businesses. These are science fiction stories with stock tickers. There's no earnings. There's no cash flow. There's no path to profitability. The valuations require growth rates that defy mathematics. This can't last. But it did last. It lasted longer than I could have imagined. The NASDAQ went up 86% in 1999 alone. Companies were doubling and tripling in days. Everyone was getting rich. And the few people who questioned it were dismissed as dinosaurs who didn't understand the new economy. I left medicine in 1999 to start my own hedge fund. I raised $600,000, mostly from family and friends. And I focused on what I understood. Value investing. Finding companies trading below their intrinsic value. Buying assets for less than they were worth. It was boring, it was old-fashioned, and in 1999, it was torture. The market went up 20%, I went up 55%. That sounds good until you realize that anyone buying tech stocks was up 100% or 200%. I was getting angry calls from investors asking why I wasn't buying internet stocks. Why wasn't I participating in the new economy? Why was I wasting time analyzing boring companies when I could just buy anything with .com in the name and watch it triple? I tried to explain that valuations mattered, that earnings mattered, that you couldn't suspend the laws of economics just because the internet existed. But nobody wanted to hear it. The market kept going up. And anyone preaching caution or value looked like an idiot. Then March of 2000 came, the top. The NASDAQ peaked at 5,048 on March 10th. And over the next 2.5 years, it fell 78%. 78%. Companies that had been worth billions went to zero. Executives who'd been on magazine covers went to jail. Investors who'd felt like geniuses lost everything. And here's what's important. I saw it coming, but I couldn't tell you the exact day it would crash. I knew valuations were insane. I knew the business models didn't work. I knew it would end badly. But I didn't know when. The market can stay irrational longer than you can stay solvent. That's not just a saying. It's a painful truth that I learned watching the dot-com bubble. Now, let me tell you why what's happening today reminds me of 1999, not 2008. Because the differences matter. The risks are different. The vulnerabilities are different. And the way this ends will be different. In 2008, the problem was leverage and interconnection in the financial system. Banks had lent money to people who couldn't repay it. They'd packaged those loans into securities. They'd sold those securities to other banks. And they'd insured them with credit default swaps. It was a house of cards built on fraudulent mortgage lending and hidden risk. When housing prices stopped going up, the whole system started to fail. Bear Stearns collapsed. Lehman Brothers went bankrupt. AIG had to be bailed out. The money markets froze. The commercial paper markets seized up. Banks stopped lending to each other because nobody knew who was solvent. It was a systemic crisis, a credit crisis, a moment when the entire financial system nearly collapsed. I saw that crisis coming too. I spent years studying mortgage-backed securities. I read hundreds of prospectuses. I looked at the underlying loans. I saw the fraud. I saw the liar loans, the ninja loans, the option arms, the loans designed to fail, and I bet against them. I created credit default swaps on subprime mortgage bonds, and I made a fortune when I was proven right. But 2008 was about systemic risk. It was about the plumbing of the financial system breaking down. It required government intervention to prevent total collapse. The Fed had to bail out banks. The Treasury had to guarantee money market funds. Without those interventions, we would have had a depression, not just a recession. Today's market is different. The banks are much better capitalized. The mortgage market is much healthier. The financial system isn't built on the same kind of hidden leverage and interconnected risk. Yes, there's leverage out there. Yes, there's risk. But it's not the same structural vulnerability we had in 2008. What we have today is much more like 1999. We have speculation. We have valuation bubbles. We have investors believing in stories instead of analyzing businesses. We have companies with no profits trading at absurd valuations because of promises about the future. We have a mania, and manias always end the same way. They pop. Let me give you specific examples of how today mirrors 1999. First, look at how companies are being valued. In 1999, internet companies were valued based on eyeballs and page views and other metrics that had nothing to do with profitability. Revenue multiples were 20, 30, 50 times sales for companies that were burning cash. The idea was that profits didn't matter because these companies would achieve such scale that eventually they'd print money. Today, we have the exact same thing with artificial intelligence companies. Companies that have minimal revenue, no profits, and uncertain business models are being valued at tens of billions of dollars because AI is the hot theme. I'm not saying AI isn't real or important. It absolutely is. The internet was real too. That didn't mean every internet company deserved a billion-dollar valuation. Look at some of these AI startups. They're burning hundreds of millions of dollars a year. They're competing with giants like Microsoft and Google who have infinite resources. They're trying to build models that cost billions to train. And investors are valuing them like they've already won. Like there's no competition. Like scaling is guaranteed. Like profitability is just around the corner. I've seen this movie before. In 1999, people said Amazon would dominate everything. They said eBay would own all commerce. They said Yahoo was invincible. Some of those companies survived and thrived. Most didn't. And even the survivors went through brutal drawdowns. Amazon fell 95% from its peak. It took 10 years to recover. If you bought at the top in 1999, you didn't break even until 2009. Second, look at the behavior of retail investors. In 1999, day trading became a phenomenon. People quit their jobs to trade stocks full-time. CNBC was on every television. Chat rooms were filled with stock tips. Books about getting rich in the stock market were bestsellers. Everyone had a story about their neighbor who'd made a fortune trading tech stocks. Today, we have the exact same thing. Retail trading exploded during COVID and hasn't fully reversed. People are trading options on their phones. They're following influencers on social media for stock tips. They're buying whatever's trending on Reddit or Twitter. The number of people treating the stock market like a casino is higher than I've ever seen outside of 1999. And just like 1999, the justifications are the same. This time is different. The old rules don't apply. Fundamentals don't matter. It's all about the story. Get in early before you miss it. If you're not participating, you're going to be left behind. These are the exact phrases I heard in 1999, word for word. Third, look at the quality of companies going public. In 1999, we had something called the dot-com IPO boom. Companies would go public with no revenue, no profits, and business plans written on napkins. The underwriters didn't care. The investors didn't care. As long as it had .com in the name, it would pop 100% on the first day of trading. Today, we have SPACs and direct listings and companies going public at valuations that assume decades of perfect execution. We have companies that lose money on every transaction going public at billion-dollar valuations. We have business models that require everything to go right, with no margin for error or competition. I'm not going to name specific companies because that's not the point. The point is the pattern. The pattern of speculation. The pattern of ignoring fundamentals. The pattern of paying any price for a story you want to believe. That pattern is identical to 1999. Fourth, look at the dispersion in the market. In 1999, there was a huge gap between growth stocks and value stocks. Tech was soaring. Everything else was languishing. The Nasdaq was making new highs while the Dow Jones was flat. If you weren't in tech, you were underperforming badly. Today, we have the same concentration. A handful of mega-cap tech stocks, the so-called Magnificent Seven, have driven most of the market's gains. Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. These 7 stocks represent a massive percentage of the S&P 500's market cap, and they've driven the vast majority of the index's returns. Meanwhile, small caps have underperformed. Value stocks have underperformed. International stocks have underperformed. It's all about a tiny number of large-cap growth stocks. That concentration is dangerous. It means the market's gains are fragile. If those few stocks stumble, the whole market can fall. This happened in 2000. When the dot-com bubble popped, the Nasdaq crashed, but the Dow Jones held up better. The market was more balanced afterward. But the process of getting there was brutal for anyone concentrated in tech. Fifth, look at the role of central bank policy. In the late 1990s, the Fed was accommodating. Interest rates were low, money was easy, liquidity was abundant. This fueled the speculation. It made it easy for companies to raise capital. It pushed investors into riskier assets, searching for returns. Then the Fed started tightening in 1999 and 2000, and that helped pop the bubble. Rising rates made the math harder for growth stocks. The present value of distant future profits declined. Capital became more expensive. The free money stopped flowing. Today, we've just lived through the most extraordinary period of monetary stimulus in history. The Fed dropped rates to zero after COVID. They bought trillions in bonds. They flooded the system with liquidity. That money had to go somewhere. It went into stocks. It went into crypto. It went into meme stocks and SPACs and anything that promised high returns. Now the Fed has raised rates back to 5%. And just like in 2000, that change in monetary conditions is going to matter. Companies that were viable at 0% interest rates aren't viable at 5%. Valuations that made sense with free money don't make sense when capital has a real cost. The tide is going out, and we're about to see who's been swimming naked. Sixth, look at the narratives. In 1999, the narrative was the new economy. The internet changes everything. Old metrics don't apply. Profits don't matter because we're building the future. Anyone who questions it doesn't understand technology. These companies are going to be worth trillions someday. So any price today is cheap. Today, the narrative is AI changes everything. We're on the cusp of AGI. These companies are going to revolutionize every industry. Old metrics don't apply because the total addressable market is the entire economy. Anyone who questions it doesn't understand AI. These companies are going to be worth trillions someday, so any price today is cheap. Do you see the pattern? It's the exact same playbook, and it ends the same way. Some of the companies survive and become huge. Most fail. And even the survivors go through brutal corrections that wipe out investors who bought at peak valuations. Now, let me talk about what's different this time. What makes this potentially worse than 1999? First, the everything bubble. In 1999, the speculation was mostly contained to tech stocks. If you owned bonds, you were fine. If you owned value stocks, you were fine. If you owned real estate, you were fine. It was a sector bubble. Today, we've had speculation everywhere. Stocks are expensive. Bonds have been expensive until recently. Real estate is expensive. Private equity is expensive. Crypto had its own massive bubble. Even collectibles and art and vintage cars have been bid up. There's been nowhere to hide. The speculation has been more broad-based than any time in history. This means when the air comes out, there are fewer safe havens. In 2000, investors sold tech stocks and bought bonds. The 10-year Treasury yield fell from 6% to 3.5% as money flowed into safety. That cushioned portfolios. Today, if stocks fall, where does money go? Bonds aren't as attractive. Cash yields something now, but it doesn't protect you from inflation. The diversification that normally protects investors may not work as well. Second, the passive investing phenomenon. In 1999, Most investors were either stock pickers or used actively managed mutual funds. Index funds existed but were a small part of the market. Today, passive index investing dominates. Trillions of dollars flow automatically into index funds that buy stocks based on market cap, not value. This creates a momentum effect. As stocks go up, they become a bigger part of the index. Index funds have to buy more. This pushes prices higher, which makes them an even bigger part of the index. It's a self-reinforcing cycle on the way up, but it works in reverse on the way down. As stocks fall, they become a smaller part of the index. Funds have to sell. This pushes prices lower, which triggers more selling. The passive bid that supported prices on the way up disappears on the way down. I'm not against index investing for most people. It's the right choice for those who don't have the time or skill to analyze individual businesses. But the dominance of passive investing changes market dynamics in ways we haven't fully seen yet. The next bear market will be the first real test of what happens when trillions in passive funds all sell at the same time. Third, the retail trading boom. In 1999, retail investors could trade stocks, but it wasn't as easy or addictive as today. You had to call a broker or use clunky online platforms. Today, trading is gamified. It's on your phone. It's instant. It's free. You can trade options with a few taps. You can buy fractional shares of anything. The barriers to speculation have been removed. This has brought millions of inexperienced investors into the market. People who've never lived through a real bear market. People who think stocks only go up. People who confuse a bull market with genius. These investors are going to panic when things turn. They're going to sell at the worst possible time. They're going to learn painful lessons about risk and volatility. The dot-com crash was brutal for retail investors, but they were a smaller part of the market then. Today, retail is a much bigger force. When they all head for the exits, the volatility is going to be extreme. Fourth, the everything app mentality. In 1999, companies focused on doing one thing well. Amazon sold books. eBay ran auctions. Yahoo was a portal. They had clear business models, even if the valuations were crazy. Today, companies are trying to do everything. They're moving into adjacent markets. They're building platforms. They're creating ecosystems. The capital intensity and complexity is much higher. This means more ways to fail, more execution risk, more competition on multiple fronts. Amazon succeeded by starting narrow and expanding slowly and methodically over decades. Today's companies are trying to do in 5 years what took Amazon 20. The hubris is extraordinary, and the failure rate is going to be high. Fifth, the geopolitical context. In 1999, the world was relatively stable. The US was the sole superpower. China was just joining the WTO. Globalization was accelerating. Supply chains were integrating. It was a time of optimism. Today, we have US-China tensions. We have wars in Ukraine and the Middle East. We have deglobalization and reshoring. We have supply chain fragility. We have political polarization in democracies. The macro backdrop is much more uncertain. This matters because it adds risk to every business model. Companies that depend on global supply chains face disruption. Companies that operate in China face regulatory and geopolitical risk. Companies that depend on smooth logistics face ongoing challenges. The margin for error is smaller. The tail risks are bigger. Now, let me talk about what happens when this bubble pops, because the pattern from 1999 is instructive. First, there's denial. The first leg down, people call it a healthy correction. They say it's a buying opportunity. They say the fundamentals are still strong. They buy the dip. This can last weeks or months. The market might even bounce, but the damage is being done underneath. The weakest companies are failing. The most leveraged investors are being forced to sell. Then comes recognition. Enough companies miss earnings, enough guidance gets cut, enough bankruptcies happen, and investors realize this isn't a dip, it's a bear market. This is when the real selling starts. This is when panic sets in. This is when the VIX spikes and circuit breakers trigger, and financial media talks about crashes. Then comes capitulation, the final leg down where everyone gives up, where investors who've held on finally throw in the towel, where the last bulls turn bear. This is usually the bottom, but you don't know it at the time. It feels like the world is ending. It feels like stocks will never come back. The decline from peak to trough took 2.5 years during the dot-com crash. From March 2000 to October 2002, 31 months of grinding lower with brief rallies that gave false hope before rolling over again. That's psychological torture for investors. And the recovery was slow. The Nasdaq didn't make a new high until April 2015. 15 years. If you bought tech stocks at the peak in 2000, you had to wait 15 years just to break even. 15 years. And that's assuming you held. Most people didn't. They sold at a loss and missed the recovery. Now, I'm not predicting the exact same timeline. Every cycle is different. But the pattern is similar. Bubbles take time to inflate. And they take time to deflate. The bigger the bubble, the longer and more painful the aftermath. Here's what I think happens. The market keeps grinding higher as long as liquidity remains abundant and investors believe in the AI narrative. But at some point, something breaks. Maybe it's earnings disappointments. Maybe it's a recession. Maybe it's a geopolitical shock. Maybe it's just that valuations get so extreme that even believers start to question them. When the selling starts, it will be gradual at first. The highest flyers will fall first. The most speculative companies, the ones with no earnings and huge valuations, they'll get cut in half, then cut in half again, then go to zero. This is what happened to Pets.com and Webvan and hundreds of other .coms. Then the selling will spread to higher quality companies. Even good businesses will fall because they're overvalued. Even companies with earnings will decline 40, 50, 60%. This is what happened to Amazon and Cisco and Microsoft. They were real businesses. But they still fell 80 to 90% because they'd been priced for perfection. The companies that survive will be the ones with strong balance sheets, real cash flow, and reasonable valuations going into the crash. They'll still fall because everything falls in a bear market, but they'll recover. They'll gain market share as weaker competitors fail. They'll be stronger on the other side. The companies that don't survive will be the ones with too much debt, no path to profitability, and business models that require everything to go right. When capital markets freeze up, these companies can't raise money. When revenues decline, they can't cover costs. They fail. Their stocks go to zero. Their employees lose their jobs. Their investors lose everything. This is the harsh reality of capitalism. Speculation gets punished. Leverage kills. Businesses that don't make money eventually run out of money. The market has a way of reverting to fundamentals. It might take longer than you expect, but it always happens. So what do? How do you position yourself for a 1999 style crash instead of a 2008 style crash? First, understand that this is not a short opportunity the way 2008 was. In 2008, I made money betting against specific mortgage securities that I knew were fraudulent. I could point to the loans, I could show the fraud, I could quantify the losses. It was a trade with a clear catalyst and a clear payout. Today's bubble is different. I can't short overvalued tech stocks and expect to make money. The market can stay irrational longer than I can stay solvent. These stocks can keep going up on narrative and momentum long after they've become absurdly overvalued. Timing is impossible, and the carry cost of being short is painful. Instead, the right approach is to focus on what you own. Own businesses that are profitable today. Own businesses with strong balance sheets. Own businesses trading at reasonable valuations. Own businesses in sectors that aren't caught up in the speculation. This won't protect you from a decline. Everything falls in a bear market, but it positions you to survive and recover. Second, keep cash. This sounds boring. Cash has an opportunity cost in a bull market. But cash is optionality. Cash lets you buy when everyone else is selling. Cash lets you sleep at night when your portfolio is down 30%. Cash is the most underrated position in a late-stage bull market. I'm holding more cash now than I have in years, not because I know when the crash will come, but because I know valuations are extreme and opportunities are scarce. When you can't find anything worth buying at current prices, the answer isn't to force it. The answer is to wait. Third, avoid the most speculative parts of the market. If it's up 300% in a year, stay away. If it has no earnings and a story about disrupting everything, stay away. If everyone you know is talking about it, stay away. These are the areas that will get destroyed in the crash. Yes, you'll miss the last leg up, but you'll also avoid the catastrophic leg down. Fourth, think in decades, not months. If you're investing for retirement 20 or 30 years from now, this bubble doesn't matter that much. You'll live through the crash. You'll keep investing through the bottom. You'll own assets through the recovery. The long-term trajectory of the economy is up. Capitalism works. Companies create value over time. But you have to have the stomach to endure volatility. The problem is that most investors don't think long-term. They check their accounts every day. They panic when things fall. They sell at the bottom. And then they miss the recovery because they're too scared to get back in. That behavior is what destroys wealth. If you can't handle volatility, you shouldn't be heavily invested in stocks. Period. Fifth, learn from history. Read about past bubbles. Study what happened in 1929. Study what happened in 1999. Study what happened in 2008. The details differ, but the patterns repeat. Speculation, excess, denial, crash, capitulation, recovery. It's the same cycle over and over. Humans don't change. Greed and fear drive the same behaviors in every generation. The investors who understand this are the ones who survive and thrive. I want to be very clear about something. I'm not rooting for a crash. I don't want people to lose money. I don't want companies to fail. I don't want employees to lose their jobs. But I also can't ignore what I'm seeing. The parallels to 1999 are too strong. The speculation is too extreme. The valuations are too stretched. The complacency is too high. Something is going to break. And when it does, it's going to be brutal for investors who've convinced themselves that this time is different. The hardest part about being early is that you look wrong for a long time. In 1999, I looked wrong all year as tech stocks soared and I focused on value. In 2006 and 2007, I looked wrong as housing kept going up and I bet against mortgages. My investors got angry. They questioned my judgment. Some of them pulled their money out right before I was proven right. That's the nature of calling bubbles. You have to be willing to look foolish. You have to be willing to underperform. You have to be willing to endure criticism and doubt. Because by the time it's obvious to everyone that there's a bubble, it's usually too late to protect yourself. The time to get cautious is when everyone else is euphoric. The time to be greedy is when everyone else is fearful. This wisdom is simple but incredibly hard to execute. It requires going against the crowd. It requires ignoring your own desire to participate in the gains. It requires discipline and patience that most investors don't have. I've been doing this for over 25 years. I've lived through the dot-com crash. I've lived through the financial crisis. I've lived through COVID. And I can tell you that what we're seeing today is far more similar to 1999 than 2008. This is a valuation bubble, a speculation bubble, a narrative bubble. It's not a systemic financial crisis waiting to happen. That's good in the sense that it probably doesn't threaten the entire financial system. But it's bad in the sense that there's no catalyst to force a resolution. In 2008, banks were failing and the government had to intervene. The crisis came fast and the response was massive. This bubble can deflate more slowly. It can grind lower for years. It can be death by 1,000 cuts instead of one catastrophic event. That's what happened after 2000. The Nasdaq peaked in March, but it didn't bottom until October 2002. 31 months of decline, with multiple bear market rallies that sucked investors back in before rolling over again. People kept thinking the bottom was in. They kept buying dips, and they kept losing money as the market ground lower. The psychology of that kind of bear market is devastating. You start to believe it will never end. You start to doubt everything you thought you knew about investing. You start to think maybe stocks are just a way to lose money. That capitulation at the end is what creates the bottom. But you don't know it's the bottom at the time. You're too beaten down to care. Here's my final message to you. Be careful, be selective, be patient. This environment is dangerous for anyone who's chasing momentum or buying stories without analyzing fundamentals. The parallels to 1999 are too strong to ignore, and we know how that ended. I'm not telling you to sell everything and hide in cash. I'm telling you to be thoughtful about what you own. Ask yourself whether the companies in your portfolio are priced reasonably relative to their earnings and cash flow. Ask yourself whether they could survive a recession and a frozen capital market. Ask yourself whether you're investing based on fundamental analysis or just momentum and hope. If you can't answer those questions clearly, you're probably more exposed than you should be. And when this bubble pops, you're going to learn an expensive lesson. I'd rather you learn it from history than from experience. Because learning from experience means losing your money. And once you've lost 50 or 70%, it's incredibly hard to recover. You need a 100% gain just to get back to break even after a 50% loss. You need a 233% gain to recover from a 70% loss. The math of big losses is brutal. This is why preservation of capital is so important. It's why I'm cautious. It's why I'm holding cash. It's why I'm avoiding the most speculative parts of the market. Not because I think I can time the top perfectly, but because I know that when you lose less in the bear market, you don't have to make as much in the bull market to come out ahead. The investors who survive and thrive over decades are the ones who avoid catastrophic losses. They don't have to hit home runs. They just have to avoid striking out. They stay in the game. They preserve capital. They wait for opportunities. And when the market is offering bargains, they have cash to deploy. Let me give you some more specific examples of companies from 1999 that illustrate these lessons. Because history is the best teacher we have, and if you understand what happened then, you'll recognize what's happening now. Take Cisco Systems. In March 2000, Cisco was the most valuable company in the world. Its market cap hit $555 billion. It was trading at a price-to-earnings ratio of over 200. Over 200 times earnings. The company was growing fast. It was the backbone of the internet. Every router, every switch, every piece of networking equipment was Cisco. The narrative was that as the internet grew, Cisco would print money forever. And you know what? The narrative was partly right. Cisco is still around today. It's still a good company. It still makes billions in profits. But the valuation was insane. At 200 times earnings, you're pricing in decades of perfect growth. You're assuming no competition. You're assuming no slowdowns. You're assuming the company will dominate forever. That's not how capitalism works. From its peak of $555 billion in March 2000, Cisco fell to $100 billion by October 2002. An 82% decline. 82%. If you bought Cisco at the peak, you lost more than 4/5 of your money. And it took 17 years for the stock to get back to its 2000 high. 17 years. In fact, on an inflation-adjusted basis, Cisco still hasn't recovered. If you bought at the peak in 2000, you're still underwater in real terms 25 years later. But here's the thing that people forget. Cisco was one of the good ones. It survived. It remained profitable. It adapted. Hundreds of other companies went to zero. Let me tell you about some of them. Pets.com is famous because they spent millions on Super Bowl ads while losing money on every sale. They IPO'd in February 2000 at $11 per share. By November 2000, 9 months later, they were bankrupt. The stock was worthless. Investors lost everything. Webvan was going to revolutionize grocery delivery. They raised $800 million. They built massive warehouses. They bought delivery trucks. They hired thousands of employees. The vision was beautiful. Order groceries online and have them delivered within 30 minutes. The execution was impossible. The unit economics didn't work. They were losing money on every delivery. When the funding dried up, the whole thing collapsed. They went bankrupt in July 2001. Again, total loss for investors. HeToys.com was going to be the Amazon of toys. They went public in May 1999 at $20 per share. The stock soared to $84 on the first day of trading. By March 2001, they were bankrupt. The stock went from $84 to zero in less than 2 years. A 100% loss. And these weren't tiny companies. These were billion-dollar valuations. These were companies with celebrity CEOs. These were companies that were supposed to change the world. They all failed. And investors lost everything. Now, let me connect this to today, because we're seeing the exact same patterns. We have companies valued at tens of billions of dollars with business models that don't generate profits. We have companies burning hundreds of millions per year, hoping to achieve scale. We have investors ignoring unit economics and focusing on total addressable market. We have narratives about disruption and transformation that assume everything goes perfectly. I'm not going to name current companies because I don't want this to be about specific bets. But look around. Look at the recent IPOs and SPACs. Look at the companies trading at 50 or 100 times revenue. Look at the business models that require perfect execution and no competition. These are the same patterns, and they'll end the same way. Let me tell you another story from 1999 that shaped my thinking. I was running my hedge fund, Scion Capital, and I was reading everything I could about these internet companies. I'd get the prospectuses, I'd read the financials, and I'd be shocked at what I saw. Companies with $10 million in revenue being valued at $1 billion, that's 100 times revenue. To justify that valuation, the company would need to grow revenue 100x and then trade at 1 times revenue, or grow revenue 50x and trade at 2 times revenue. The math didn't work. But when I'd point this out, people would tell me I didn't understand the new economy. They'd say I was stuck in old paradigms. They'd say the internet changed everything and traditional valuation metrics were obsolete. I heard this over and over, from investors, from analysts, from journalists, from friends and family. Everyone was convinced that this time was different. And here's the psychological trap. When everyone around you is making money and you're not, you start to doubt yourself. You start to think maybe you're wrong. Maybe you're missing something. Maybe the rules really have changed. This is why bubbles are so dangerous. They create a social proof that overwhelms individual judgment. If everyone you know is getting rich, it's incredibly hard to stand aside and say, no, this is insane. I maintained my discipline. I stuck to value investing. I bought companies trading below book value. I bought companies with low price to earnings ratios. I bought companies that were out of favor. And in 1999, I underperformed. My fund was up 55%, which sounds great until you realize the Nasdaq was up 86%. My investors were frustrated. Some of them pulled their money out. They wanted to participate in the tech boom. Then 2000 came, and everything changed. The companies I owned held up. The tech stocks collapsed. By 2002, my fund had massively outperformed. The investors who'd pulled their money out to chase tech stocks had lost most of it. The investors who stayed with me and trusted the process did extremely well. That experience reinforced everything I believe about investing. Stick to fundamentals. Ignore the noise. Be patient. Let others chase momentum. Focus on value. Now, let me talk about the role of media in both bubbles. In 1999, CNBC was on every television. Financial news became entertainment. Analysts would come on and tout stocks. They'd give price targets that implied 100% upside. They'd talk about paradigm shifts and new eras. The anchors would get excited. The guests would get excited. Everyone was feeding the frenzy. I remember watching these shows and being amazed at how disconnected from reality they were. Analysts would recommend stocks trading at 300 times earnings and say they were cheap because of the growth potential. They'd compare companies to Amazon and say this is the next Amazon. They'd use metrics like price to eyeballs or price to page views, metrics that had nothing to do with cash flow or profitability. Today, we have the same thing, but on steroids. Social media has amplified everything. You have influencers on Twitter and YouTube telling people what to buy. You have Reddit communities coordinating purchases. You have TikTok videos about getting rich in the stock market. The noise is louder than ever. The speculation is more democratized than ever. And the potential for people to lose money they can't afford to lose is higher than ever. This is particularly dangerous because many of the people speculating today have never lived through a real bear market. They started investing during COVID. They've only known markets that go up. They think buying the dip always works. They think the Fed will always rescue the market. They have no concept of what it's like to watch your portfolio fall 50% and keep falling. They have no emotional preparation for the pain that's coming. Let me tell you what a real bear market feels like. Because I lived through the dot-com crash. I watched my own portfolio decline, even though I was mostly in value stocks. I watched friends and colleagues lose everything. I watched people who'd felt like geniuses become broken and depressed. The psychological impact of a major bear market is devastating. It's not just about losing money. It's about losing confidence, losing trust, losing hope, wondering if you'll ever recover. In 2000 and 2001, I'd talked to other investors and they were shell-shocked. They couldn't believe what had happened. They couldn't believe their portfolios were down 70 or 80%. They couldn't believe companies they'd been so confident in had gone bankrupt. They felt stupid. They felt betrayed. They felt like they'd never invest in stocks again. That capitulation, that total loss of confidence, is what marks the bottom. But it takes years to get there, and most people can't endure it. They sell at some point during the decline, they lock in their losses, and then they miss the recovery because they're too scared to get back in. This is why I stress the importance of only investing money you can afford to leave invested for decades. If you might need the money in the next 5 years, it shouldn't be in stocks. Because you cannot predict when bear markets will come or how long they'll last. And if you're forced to sell during a downturn, you'll lock in losses you can never recover. Let me also talk about the role of leverage in making these bubbles worse. In 1999, people were buying stocks on margin. They'd put up 50% of the purchase price and borrow the other 50% from their broker. This worked great when stocks went up. If you bought $20,000 worth of stock with $10,000 of your own money and $10,000 borrowed, and the stock doubled, you'd make $20,000 on your $10,000 investment. A 200% return. But leverage is a double-edged sword. If that stock falls 50%, you've lost all your money, plus you still owe the broker. Margin calls would go out. People would be forced to sell. This would push prices down further, which would trigger more margin calls. It was a vicious cycle. In 2000 and 2001, margin debt collapsed as investors either paid off their loans or got wiped out. The decline in margin debt correlated almost perfectly with the decline in stock prices. Today, we have even more ways to leverage. You can trade options. You can buy leveraged ETFs. You can use portfolio margin. You can borrow against your crypto. The financial system has created more and more ways for people to amplify their bets. And while this can multiply gains in a bull market, it multiplies losses in a bear market. When the next downturn comes, the forced selling from leveraged positions is going to be brutal. Options are particularly concerning. In 1999, options existed, but they weren't as accessible or popular as today. Today, retail investors are trading billions of dollars in options every day. Many of them don't fully understand what they're doing. They're buying call options because they've seen other people make money. They're treating it like a lottery ticket. The problem is that options are a zero-sum game. For every winner, there's a loser. And the losers are usually the retail traders who don't understand the math. When volatility spikes in a bear market, option values swing wildly. People who sold options can face unlimited losses. People who bought options see them expire worthless. The complexity and leverage in options makes them incredibly dangerous for inexperienced traders. But that hasn't stopped millions of people from trading them. This is going to end badly for a lot of people. Let me now talk about the comparison to Japan. Because Japan's bubble in the 1980s and subsequent lost decades offer another important lesson. In the late 80s, Japan was on top of the world. The Nikkei stock index soared. Real estate in Tokyo became the most expensive in the world. Japanese companies were buying trophy assets around the world. The narrative was that Japan would overtake the United States as the world's largest economy. It felt unstoppable. Then the bubble popped. The Nikkei peaked at 38,916 inches December 1989. It then fell 82% over the next 13 years. It didn't bottom until 7,603 inches March 2003. And even today, 35 years later, the Nikkei has only recently surpassed its 1989 peak. For 34 years, if you bought Japanese stocks at the peak, you were underwater. 34 years. The lesson from Japan is that bubbles can take decades to recover from. The bigger the bubble, the longer the aftermath. Japan's economic growth stagnated. Their demographics declined. They fell into deflation. They tried massive fiscal stimulus. They tried zero interest rates. They tried quantitative easing. Nothing worked to restore the growth they'd had before the bubble. They had 3 lost decades. Could the United States face a similar fate? I don't think so. Our demographics are better. Our economy is more flexible. Our capital markets are more efficient. But the Japan example shows that bubbles have long-lasting consequences. They misallocate capital. They create bad investments. They leave scars. The bigger the bubble, the bigger the hangover. This is another reason why I think today's bubble is more concerning than many people realize. We've had speculation in everything. Stocks, bonds, real estate, crypto, private equity, venture capital. The amount of capital that's been misallocated is enormous. When this all unwinds, the damage is going to be widespread and long-lasting. It won't be a quick crash and recovery like 2009. It will be a grinding adjustment as all these misallocated resources get repriced and reallocated. Now, let me discuss the psychological stages investors go through in a bubble. Because understanding this helps you recognize where we are and what's coming. Stage 1 is disbelief. Prices start going up, but most people think it's temporary. They've been burned before. They're skeptical. This is usually the best time to buy. but very few people do because they don't believe it's real. Stage 2 is acceptance. Prices keep going up. More people start to believe the rally is real. They start to participate. The gains become steady. This is when most people get involved. It's still relatively early, but it feels safer because the trend is established. Stage 3 is enthusiasm. Prices are soaring. Everyone is making money. People start to get excited. They tell their friends. They increase their positions. The gains feel easy. This is when the media coverage intensifies. This is when dinner party conversations turn to stocks. This is when everyone has a story about how much money they're making. Stage 4 is euphoria. This is the peak. Everyone is all in. Nobody can imagine prices falling. The gains have been so consistent and so large that risk seems to have disappeared. People leverage up. They quit their jobs to trade full-time. They make financial decisions assuming the gains will continue forever. Then comes stage 5, which is denial. Prices start to fall. But everyone tells themselves it's just a healthy correction. It's a buying opportunity. The fundamentals are still strong. This is when people double down. They buy the dip. Some of them make money as the market bounces. But the character of the market has changed. The easy gains are over. Stage 6 is fear. Prices keep falling. The bounces get smaller and shorter. Volatility increases. People start to worry. They check their accounts more often. They have trouble sleeping. They wonder if they should sell. But they haven't yet. They're still hoping it will come back. Stage 7 is panic. This is when the real damage happens. Prices are in free fall. The news is all bad. Companies are missing earnings. Bankruptcies are being announced. Margin calls are going out. This is when people sell at any price. This is when fortunes are destroyed. Stage 8 is capitulation. This is the final stage. This is when even the strongest bulls give up. When the last holders throw in the towel. When everyone agrees that stocks are going to zero and will never come back. This is usually the bottom, but you don't know it at the time. Right now, in late 2025, we're somewhere between stage 3 and stage 4. We're in enthusiasm heading toward euphoria. People are excited, they're making money, but we haven't reached the peak craziness yet. That will come when even the skeptics give up and get fully invested, when the last bears turn bullish, when every measure of sentiment is at extremes. That's when you know the top is near. But timing it is impossible. I learned this in 1999. I knew we were in a bubble in 1998. I knew valuations were crazy. But the bubble inflated for another year and a half. If I'd shorted tech stocks in 1998, I would have been wiped out. The market can stay irrational longer than you can stay solvent. That's not just a clever saying. It's a brutal truth that has destroyed countless investors who were right about the direction but wrong about the timing. This is why my strategy is not to short the bubble. It's to avoid participating in the most speculative parts. It's to focus on value. It's to hold cash. It's to wait for opportunities. When the crash comes, and it will, I'll be ready. I'll have capital to deploy. I'll be able to buy quality businesses at bargain prices. I'll be able to take advantage of others' panic. That's how you win over the long term. Let me also address the argument that the Fed will rescue the market. This is something I hear constantly. People say, don't fight the Fed. They say the Fed will always step in and support asset prices. They say as long as the Fed is printing money, stocks will go up. This argument was used in 2008, and it was partly true. The Fed did step in massively. They cut rates to zero, they bought trillions in bonds, they provided unlimited liquidity to the financial system. And this helped stabilize markets and prevent a depression. But here's what people forget. The Fed was able to do that because we had deflation and a financial crisis. They had room to cut rates from 5% to zero. They had justification to print money because credit markets were frozen. Today is different. We don't have deflation. We have inflation. The Fed just spent the last 3 years raising rates to fight inflation. They can't immediately reverse course and start cutting and printing money again without losing all credibility. If they did that, inflation would come roaring back. The dollar would collapse. We'd have a currency crisis on top of everything else. So, the Fed put is not as strong as people think. Yes, eventually they'll cut rates if the economy slows. Yes, eventually they might do more quantitative easing. But they can't prevent a major market correction. They can't stop a bubble from popping. At best, they can cushion the fall and help with the recovery. But the pain has to happen. The misallocated capital has to be repriced. The speculation has to be wrung out of the system. You can't prevent that. You can only delay it. And delays often make it worse. This brings me to another important point about inflation. In 1999, inflation was low. The Fed had credibility. The dollar was strong. Today, we're coming off a major inflation spike. The Fed had to raise rates aggressively to bring inflation back down. That fight isn't necessarily over. If they ease too much too soon, inflation could come back. This limits their flexibility to support asset prices. They have to balance fighting inflation with supporting growth. That's a much harder position than they were in during past crises. Moreover, if the market crashes while inflation remains elevated, we could have the worst of both worlds: stagflation, falling asset prices and rising consumer prices. That happened in the 1970s, and it was miserable for investors. Stocks went nowhere for a decade in nominal terms, and in real terms, they lost significant value. Bonds got destroyed by inflation. There was nowhere to hide except commodities. I'm not predicting stagflation, but it's a risk. And it's a risk that most investors today have never experienced and don't understand. Let me now talk about international markets, because one difference between today and 1999 is the global context. In 1999, the dot-com bubble was mostly a US phenomenon. Yes, there was speculation in Europe and Asia, but it was centered in the United States, the Nasdaq, Silicon Valley, American companies. When the bubble popped, international markets held up better. Emerging markets actually did well in the early 2000s. There was diversification available. Today, the speculation is more global. China had its own tech bubble. Europe has seen speculation. The entire world followed the Fed into zero interest rates and quantitative easing. Everyone printed money. Everyone inflated asset prices. This means when the correction comes, it's likely to be more synchronized. There may be fewer places to hide. Diversification may not work as well as it did in the past. China is particularly concerning. They've had their own massive bubble in real estate and infrastructure. Their stock market has bubbles in tech and electric vehicles. Their economy is slowing. Their demographics are terrible. Their political system is becoming more authoritarian. I would not want to be invested in China right now. The risks are too high, and the returns don't justify them. Europe is less speculative but faces its own challenges: energy crisis, competitiveness issues, political fragmentation, demographics. The European economy has been stagnant for years, and I don't see that changing. The US remains the best market in the world, but that doesn't mean it's immune from a major correction. Emerging markets are interesting. Some of them offer value. Some of them have better demographics and growth prospects than developed markets, but they also have higher political risk, higher corruption, less rule of law, less developed capital markets. For most investors, the added risk isn't worth it. But for those willing to do deep research, there may be opportunities. Now, let me talk about what I'm actually doing with my own portfolio, because actions speak louder than words. I'm holding a significant amount of cash, more than I have in years. This is deliberate. I'm not finding many investments that meet my criteria for value and margin of safety, so I'm waiting. I'd rather hold cash and earn a safe return than overpay for assets. I'm investing in some smaller value stocks that nobody cares about. Companies trading below book value, companies with low price-to-earnings ratios, companies that are out of favor. These won't protect me completely if the market crashes, but they're much less overvalued than the market overall, and they have margin of safety. I'm avoiding anything with a story but no earnings. I'm avoiding anything trading at extreme valuations. I'm avoiding anything that's up 200 or 300% in a year. I'm avoiding crypto. I'm avoiding SPACs. I'm avoiding most IPOs. I'm avoiding the speculation. I'm focused on old economy businesses that generate cash flow and trade at reasonable prices. This means I'm underperforming in the current market, and that's fine. I'm not trying to maximize returns this year. I'm trying to preserve capital so I have resources when the opportunity comes. And the opportunity will come. It always does. I'm also thinking about hedges. Not to time the market, but to protect against extreme scenarios. I'm looking at out-of-the-money put options on indexes. I'm looking at volatility strategies. I'm looking at assets that would do well in a crisis. Gold, treasuries, cash. The goal isn't to make a fortune on these hedges. The goal is to have some protection if everything falls apart, to have some cushion that allows me to stay invested in my core positions without panicking. Let me close with some thoughts on what you should do, because ultimately, you have to make your own decisions based on your situation. But here are the principles I'd follow. First, assess your risk tolerance honestly. If you can't handle a 50% decline in your portfolio without panicking and selling, you have too much risk. Reduce it now. Move to cash. Move to bonds. Move to whatever lets you sleep at night. There's no point in having an optimal portfolio allocation if you're going to abandon it at the worst possible time. Better to have a suboptimal allocation that you can stick with. Second, focus on quality. If you're going to own stocks, own good businesses. Profitable businesses. Businesses with strong balance sheets. Businesses with competitive advantages. Businesses that can survive a recession. Don't chase speculation. Don't buy stories. Buy earnings and cash flow. Third, don't use leverage. This is critical. Leverage magnifies losses. It creates forced selling. It turns corrections into catastrophes. If you're borrowing to invest, stop. Pay off the debt. Invest only what you own outright. The modest boost to returns in good times is not worth the risk of ruin in bad times. Fourth, hold cash. Yes, cash has an opportunity cost. Yes, you're missing out on gains while the market goes up. But cash is optionality. Cash is emotional comfort. Cash is ammunition for when the crash comes. The investors who have cash during a bear market are the ones who get rich. The investors who are fully invested and leveraged are the ones who get destroyed. Fifth, think long term. If you're investing for retirement decades from now, short-term volatility doesn't matter. Stay invested. Keep buying through the downturn. Dollar cost average. Trust that the economy will grow and businesses will create value over time. Don't panic. Don't try to time the market. Just stay disciplined. And finally, educate yourself. Read about past bubbles. Study market history. Understand what works and what doesn't. Understand that patterns repeat because human nature doesn't change. Greed and fear drive the same behaviors in every generation. The specific details differ, but the underlying dynamics are identical. If you understand this, you have an enormous advantage over most investors who think this time is different. So that's my message. This market looks like 1999, not 2008. It's a valuation bubble, a speculation bubble, a bubble driven by narratives and momentum rather than fundamentals. It will end the same way all bubbles end, with a crash that punishes speculation and rewards discipline. I don't know when. Nobody does. But I know it's coming. And I know the pain will be severe for those who aren't prepared. So, prepare now, while you still can. While there's still time to reduce risk and build cash and focus on quality, don't wait until the crash is underway. By then, it's too late. The time to be cautious is when everyone else is euphoric. The time to be greedy is when everyone else is fearful. That's how you survive and thrive over the long term. That's the lesson from history. And history is repeating itself right now.